The following was recorded in front of a live studio audience at the Studio 21 Podcast Café. This is the United Podcast Network.
Welcome to the Stock Market Authority podcast. I'm Bakes, Kevin Baker. I'm going to teach you how to make money in up and down markets. Very few podcasters or coaches cover this. I'll show you how to lock in profits and minimize losses to make you a better investor. So once a week, you're going to know what's going on in the world and the stock market. Welcome to the Stock Market Authority podcast. Good morning. This is Bakes. Happy Wednesday to you. Merry Christmas, more importantly. I'm Bakes, the Stock Market Authority. Kevin Baker. My mom calls me Kevin. Everybody else calls me Bakes. Welcome. Today we're going to cover economists can't pick stocks. And I know I'm going to offend some of my economist friends, but I think deep down they know that's the case. Economics news is useless in investing. That sounds strong, but I'm going to prove it to you. We're going to open the mailbag. We're going to talk about crypto and Tesla. Yes, again, but there's so much going on that it warrants it. And we're going to go through the portfolio. We are still up in this down market, and I think that's quite an accomplishment that I'm proud of, and I want you to improve your performance and follow along with what we're doing. So right now, please go to my website, stockmarketauthority.com. Sign up for free for my newsletter. Subscribe to my YouTube channel and my podcast, wherever you podcast. Follow me on your favorite social media where I break in with new things about crypto and Tesla. And you're smart people. This is not financial advice. I don't know your situation in and out. And so let's go. Let's go to the top story. Josh Brown put out a post yesterday. I really like Josh. He is on CNBC, it seems like constantly. He is the CEO of Ritholtz Wealth Management, puts out a ton of content, and he put out what he saw coming up this week. And so we had a lot of economic news, and we still have more to come. But he pointed out that yesterday we had the CPI. The Consumer Price Index, how much inflation there is in the system. And then today, we're going to have the Fed meeting, and we're going to have the press conference at 2, and then we're going to have initial and continuing jobless claims at 8:30 and retail sales tomorrow. And I had a knee-jerk response to this, and I said, if I had the press releases for all of those, all the data, all the details, if I had it prior to all these events, I don't know how I would make money. And so that's why I say economists can't pick stocks, because I always ask the question, how do you make money from this? And if the answer is I can't, I kind of yawn and go on to other things. So let's go to the first chart. This is the CPI chart. And again, there's a lot of moving parts here, different components, what have you. And if you had given this to me the day before, I couldn't have said it's going to mean this for airlines. It's going to make housing stocks go down. It's going to make retailers go up. There's nothing to do here. And what ended up happening is that inflation came in at 7.1%, and the street expected 7.3%. And literally, I watched this at 8:30 yesterday, and as soon as that headline came out, the Dow went up 700 points, the NASDAQ went up 4, the S&P went up 3 for the first half hour. And so the taking this information and utilizing it, there's algos and computers that are doing this over the short term, but over the long term, you can't do anything with this. And to take it even further, 7.1% isn't 2%. And so it's better than what people expected, but the Fed says we're going to raise rates until inflation is 2%. They didn't say that as explicitly as I just pointed out, but that's pretty much what's going to happen. And how you make money in stocks from that is I'm going to let the charts direct me. They're going to tell me where to look, where there's opportunities, where to do more research, and I encourage you to follow along. Because if you take a view that I think I know what's going on in the economy and it's going to come down to this group of stocks and make them perform badly or well, It doesn't work. It just doesn't work. And if someone can prove to me otherwise, I'm all ears. I'm open-minded. But I've been doing this for 25 plus years, and I can't see it happening. Next, Josh pointed to the put-call ratio. Now, this gets a little wonky, or this is about as wonky as I'm going to get. But bottom line is a put option gives you the ability to sell a stock at a certain price in a certain period of time, and a call option allows you to buy a stock at a certain price at a certain time. And so when the put-call ratio is elevated, it suggests that people are scared, everybody's bearish, in quotation, as I'm doing air quotes here, for my listeners, and it suggested that everybody is prepared for a downturn. Well, and so the converse comes up to be that, all right, so everybody's prepared that way. They're going to get caught off sides, and stocks are going to rip. They call it, a rip your face off rally is the phrase du jour. Well, okay, I look at this chart and I say, yeah, okay, that's a pretty high number. I get it. It's already come off of that. So if you had positioned yourself, you had to sort of change your view in 7 days. It's insanity to me. Now, I'm going to take another step back. The reason why the talking heads of CNBC do all this, it makes them sound smart. And so when they go to their high net worth individual clients, they can say intelligent things about auto sales and home starts and retail sales and what have you. But at the end of the day, I'm in this to make money for you and for me. And the economists don't get the job done. It just doesn't make any sense. So with this whole consensus that everybody's bearish, well, we'll see how that plays out. So then I go to the S&P chart, and I watched this yesterday. The news came out, stocks ripped, and it came up to that 410 level on the S&P, which is the prior high, which is why I point to these charts so often. I can't tell you how many times these prior levels, resistance, get respected. And so in the first half hour of trading, we go up and kiss 410, and then we spent the whole day reversing down. While I was writing the show, it was about 1 PM. We were flat on the day. Completely reversed this manic move in the first half hour. Another point I'll make is I want you to start discounting the first half hour. Think about it. That's where everybody's had their third cup of coffee. It's emotional. You have a news item comes up that people are pounced on. The computers are certainly getting ready to pounce on it, and it creates outsized moves in that 9:30 to 10 period. And I wouldn't react too much to that. Now, I was getting my head kicked in that first half hour. And luckily, I've been doing this long enough, I sat on my hands and watch all my positions perform much better over the course of the day. And I'm not a day guy. I haven't found a day trader that makes money consistently, and I'm sure not going to be him. So you're not the folks that are coming in here realize that I identify long-term trends, jump on them, and hopefully ride them to long-term capital gains in up and down markets, as I've said. So I hope I've impressed upon you that I want to be cognizant of what's going on. I want to know extremes. I want to, understand what people's bullish and bearish viewpoints are in the economy. But then to get that down to brass tacks and making money in stocks and ETFs, that's where I come in with the charts. And the charts say you want to be where I am right now, 33% in cash, largely short, and owning commodities right now. So a lot more to come. We'll talk about that more in the portfolio. But economists can't pick stocks. Frankly, I can, and I want to do it for you, and I want to be helpful. And I want you to please go to my website, stockmarketauthority.com, sign up for my free newsletter. Please subscribe to my YouTube channel and my podcast. Please share it if you think I add value, and I hope I do. Follow on your favorite social media. And again, this isn't financial advice. Let's open the mailbag next, please.
There's a letter in your mailbox.
You got mail. That's almost frightening. Charlie from New York wrote in, actually texted me right after the last show. Is crypto like Amazon in 2002? And there's so much in there, it's unbelievable. So please keep those cards and letters coming in, boys and girls. I really want to hear from you. There's a few components. I'm going to take the Amazon component first, and then I'm going to take the crypto component. So bear with me. I had forgotten a lot of this. I had been through this and this period of time. That's how old I am. You can't imagine how crazy it was 98, 99, 2000 as every Pets.com stock just went to the moon. That was the original moonshots. Amazon, while it's viewed now as this giant successful company, its existence bankruptcy was a real issue back in 2002. So the stock market, the tech bubble cracked in the early 2000s, and then this stock went down 90% to below $1. Think about that. Look at this chart if you can on YouTube and on Facebook. Amazon got absolutely crushed. And so all these people that say, oh, I bought Amazon at $1. No, you didn't, okay, because it looked like the world was coming to an end. What I want you to point out, first of all, is the second arrow from the left, is that's the buy point. And that's a real bull market reemerging. And I don't see these charts out there. Certainly in Amazon, because it's rolling over, as I've mentioned in my How to Sell video. This is what I'm looking for all the time. You don't have to do it because I'm going to do it for you, and I don't find it yet. So you don't have these bases. You don't have capitulation. You don't have stocks ripping higher on neutral to bad news, and we're just not there yet. But my other point is, look at the first arrow to the left, and this is a bit of history. Back in February of 2000. The company was in a lot of trouble, burning money, losing money, basically just selling books at a loss. And the CFO, whose name I can't remember now, very intelligently sold a convertible bond offering in February and brought in $672 million at a 6.9% interest rate, which seemed high at the time. But that $672 million in cash that they put on the balance sheet enabled them to ride out those losses, those burn rates, losing money all those years to get to the AOS and the Amazon that you know today. That is, an absolute giant. So, number one, I don't see Amazons like this out there yet. I'm looking for them. Believe me, I'll let you know when I see them. And number two, Amazon's a real company with a revenue line and expenses and a bottom line. And crypto does not have that. There's no balance sheet. It is simply a belief system. And you think that a Bitcoin is worth X dollars and it's going to be 2x dollars down the road because you believe that it's digital gold, it's a hedge against the central banks losing their minds and printing money. And we talked about this last week. I'm going to pick on Bitcoin. Simply because Bitcoin has gone from 67,000 down to 17 does not mean it's cheap. Things can go down by 60, 70, 80%, and then go down 60, 70, 80% again. See Carvana and see all the examples we talked about last week. So crypto, there's no balance sheet of cash that you can say that's the base, that's the bottom. It's not going lower than that. It is... I had a friend that I talked to yesterday ask me about crypto, and we had a friend of the pod who said, I'm all in on crypto. It's cheap down here. And what I would say is you pick a number that you're willing to go to zero, that's how much crypto you should own. That's the number, because it's very likely to go to zero, and I don't want you being like an FTX bag holder, losing significant, serious money that is material to your life. I really don't want that to happen. Am I being vague? Okay, I don't think so. So we talked about that. Next is Tencent. Dan from Massachusetts asked about Tencent, Chinese technology company. I'm not immersed in the fundamentals here, but I know how to read a chart. And Dan, what I see here is a stock that got driven down to the low 20s, mainly because of the COVID shutdowns, I believe, and bouncing on the relaxation of the COVID restrictions that the Chinese government has finally had to do. And what did we do? We bounced to this 41 level. Look at this line that I've drawn. That's a 3-year line of resistance. And we're stalling out there. And there's a lot of people who bought the stock back in 2018, 2019 that are saying, it's like a hangover. If you get me out of this one, Lord, I'll never drink again. If you get me out of this stock, let me sell it here. I'll never buy it again. And I think that's what's going to happen here. We've bounced to 41. I think it's very unlikely to break through this resistance, as heavy as it is, as long as it is. Certainly on the first try, it takes some time. You also mentioned to me that you have a double in this. Well, good for you. That's impressive. Anytime you have 100% gain, I always suggest that you take the original investment, especially if you earned it in a short period of time, take the original investment out, put that on the side, play with the house money, and let those gains run, and then deploy my sell discipline that I talk about so much. So good for you, Tencent. I would get out of Dodge, say thank you, pay the tax, and let's go find some other ideas. Scott from London came in with an idea that I've been talking about that I don't want you to be involved with, and it's Tesla. And I know this is sort of kryptonite for some people, that a lot of people genuflect to Elon Musk. He's going to save the world. He's going to go to Mars. Oil companies are evil, and he's the antithesis of that. No, don't buy any of that, frankly. It's a car company that went from losing money, got into the S&P, had a lot of demand, and now that's all changing. It rolled over. I put out a post yesterday, which I really recommend you look at, less than 2 minutes, and I said if it breaks 200, 163 is the next stop. It happened yesterday. Okay, even overran it a little bit. Goldman Sachs is out today talking about lowering their price target to 205, which, oh, by the way, thank you. I was there 40 points ago. And number two, that's where the breakdown happens. So you're definitely going to see a lot of people come in if it ever gets to that level, which I think is highly unlikely. I think it's highly unlikely because I listen to more podcasts than anybody, a lot of left-leaning ones, so I know what they are saying, and they're saying, I'm driving away from Tesla. I'm selling my Tesla. I'm not going to buy a Tesla. I'm not going to buy my kid a Tesla. They don't want to be associated with the brand of Elon anymore. This Twitter fiasco is getting worse by the day. He's alienating his base. And frankly, he can't turn it around now. He can't say, sorry, I was kidding about all the stuff I've been posting on Twitter about right-wing conspiracy theories. So I think the cat's out of the bag, and I think Tesla's going lower. So if you want to drive the car, that's fine. I gave you another line here. I think 126 is next. And that is not going to be that tough to go to. The earnings number next year is 577. I doubt they hit it. I think it's going to be more like 5. You put a reasonable 25 multiple on that gets you to 125. And I think that's where you go. And that's about as sophisticated as you have to be with this sometimes, is the numbers are coming down, and that means the stock's coming down, and the expectations and the valuation are high. And if you want to sell Tesla, the car, that's up to you. But I wouldn't touch Tesla, the stock, for the foreseeable future. Let's go to the portfolio, folks. I put my money where my mouth is. I listen to more podcasts than anybody, and I don't see anybody doing this. So this is my real account and with real money, and I have my outside of the S&P retirement stuff. I have this, and here it is by the month. We're up 1.1% for the year in a market that's down 14. I think that's pretty darn good. All the numbers are here. Please go to the YouTube channel or the Facebook channel to take a look at this stuff. I can't be more transparent about what I'm doing, and I hope here I'm telling you why I'm doing it. Since inception, we're up 30% plus. We're in line with the S&P, and we're 4 times the hedge funds that charge 2 and 20. So 2% and 20%. So I'm pretty happy about this. And frankly, when I started this 2.5 years ago, I came out of the traditional asset management world that was hugging indices all the time and saying that you had to be, X percent next to the index in healthcare and technology, and you can't hold any cash, and you have to lose money when the market goes down and try not to lose as much as the next guy. And I thought this would work, but now I know it works. It's 2.5 years, and I hope you know it works for you. So please follow along and fire ideas at me. I'm a voracious reader and an observer, but I miss things, and I want to know what you want me to pay attention to. A friend of mine talked about, frankly, disagree with my real estate call to an extent. Bob from Massachusetts, from Pennsylvania, and said I'm going to back up a little bit. We talked about this last week, so I'm not going to assume that you're here for this. The Blackstone REIT, BREIT, is one of the largest, most successful private REITs, real estate investment trusts in the country, and they own warehouses, data centers, residential housing in the Sun Belt, et cetera. Been very successful, up 9% for the year, while the public REITs are down 20. And so people say, how are they doing that, and what's going on? Well, they are, the Blackstone management is saying we have, I'm going to say crazy rich Asians. That isn't what they say. That's the movie that I didn't see back in 2017. But for some reason, the Blackstone management is saying we're getting Asian redemptions tied to the Hong Kong market collapse. And I don't understand why their origin or ethnic group matters as far as if they're redeeming. If they're redeeming, who cares who they are? But anyway, they're using that, and it's a little Shakespearean. I think they doth protest too much. Schwartzman, the CEO, has been everywhere. There's been a number of folks on various podcasts, Odd Lots, etc., and they all say, we're really good at this. Our numbers are great over the long term. We've had a great 6 years, and don't ignore these fund flows. We're really good at this. Well, okay, the last 6 years has been almost ideal in terms of the Fed helping you with lower rates to excel in real estate. And a little known fact that the Wall Street Journal brought up the other day is most of this year's gains have come from a derivative trade, a bet on interest rates. So almost 8 of the 9% is coming from that. So I'm going to keep things simple. If Blackstone has a problem, real estate has a problem, everybody has a problem. We own REK, the short real estate ETF, in our portfolio, and frankly, it hasn't done much yet. But I can see the writing on the wall. I can see this Blackstone chart, and it's telling me that there's going to be downward pressure on data centers and warehouses for the foreseeable future, and we're going to profit from that. So I just want to give you my thought process and my feedback. Lastly, We own, and a lot of our gains this year have come from shorting Cathie Wood, the ARK Innovation Fund, ARKK. We own SARK, SARK, from AXS and Matthew Tuttle. And Cathie Wood owns Roku, Zoom, Tesla up to her eyeballs. Those are the big three names. And they're either losing money or very highly valued. And that ship has sailed. Interest rates are going up. These are coming down. And I was struck by this chart yesterday where, again, I was getting my head kicked in the first half hour, but ended up for the day, given cooler heads prevailing in the last hour of trading. So I'm looking for these winners that are up 90% plus all the time. I'm going to find them. I've got a number of things that are percolating that come from my chart work, and I will certainly relay that to you. Folks, that's the show. And after talking about down markets, we need much needed levity. My brother Kent came to me and said, you got to check out Sebastian Maniscalco. Is It Me on Netflix. It is absolutely hilarious. I've seen his other specials. I recommend them highly to you. And I also recommend, send me your funny stuff, because this can be heavy at times and serious, and I want to lighten it up. And if you have things that I should be forwarding to my audience, I want to do so. And obviously, there's a link in the description below. Please go to my website, stockmarketauthority.com. Sign up for free for my newsletter. Subscribe to my YouTube channel and podcast. Follow on your favorite social media. Write to me, please, Bakes at stockmarketauthority.com. DM me on Twitter at BakesTakes_. I love your feedback. I want to be helpful. Tell me how I can do more so. There's the closing bell. Thank you. I'm Bakes. This is the Stock Market Authority, and Merry Christmas to you and yours. Bye now.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Café, the United Podcast Network, its partners, or affiliates.